In this video, we will explore the terminology used in the debt market. When we talk about debt capital, we are essentially talking about money provided by lenders. These lenders expect two things: a fixed rate of interest paid regularly and the return of their original money after an agreed period. A company can raise this capital in two ways. First, it can take a loan from a bank or a consortium of banks. Second, it can issue debt securities to a pool of investors. Think of it this way. If a company issues 1 crore securities with a face value of 100 rupees each, an investor with 1000 rupees can buy 10 of those securities. Now that we understand the basic structure, let us look at the classifications of debt. There are a few core features every debt contract has, such as the principal amount, the coupon or interest payment, the maturity date, and whether there is collateral. Based on collateral, we have secured debt and unsecured debt. Secured debt gives you rights over specific assets. If the company defaults, those assets can be sold to repay you. Unsecured debt carries higher risk because you have no specific rights over assets. We can also classify debt by how it is issued. A public issue is listed on stock exchanges like the NSE or BSE and traded openly. A private placement is offered to a select group of investors and usually trades on the over-the-counter market. Let us dig deeper into the specific terms, starting with face value. This is the nominal or par value of the debt paper. It answers the fundamental question: how much borrowing does this specific paper represent? If the face value is 1000 rupees, that is the loan amount for that specific bond. This number is crucial because it acts as an anchor. The interest payments, which we call coupons, are always calculated as a percentage of this face value, not the market price. Speaking of interest, let us talk about the coupon rate. This is the fixed percentage of the face value that the issuer pays to you. For example, if you see a government security labeled 8.24 GS 2018, the 8.24 represents the coupon rate. It is important not to confuse this with the general interest rate, which refers to the broader market rates controlled by the central bank. If you have a bond with a face value of 1000 rupees and a coupon of 8.24%, your annual payment is 82 rupees and 40 pies. Since government securities usually pay semi-annually, you would receive 41 rupees and 20 paise every 6 months. The next critical term is maturity. This is also known as tenor. It refers to the lifespan of the bond. It can range from very short term, like treasury bills which might mature in 91 days, to long-term government securities that last up to 30 years. There are even perpetual bonds that technically go on forever. Maturity is the single largest factor affecting price volatility. As time passes, the term to maturity reduces daily until it hits zero on the redemption date. We need to distinguish between face value as a concept and face value as a liability. The face value represents the rigid legal debt. No matter how much the market price fluctuates up and down during the life of the bond, the issuer is legally liable to repay only the face value upon maturity. Even if you bought the bond in the secondary market at a higher or lower price, the company owes you the principal amount stated on the paper. This brings us to market price. Unlike the fixed face value, the market price fluctuates based on three drivers: market interest rates, inflation, and default risk. There is an important rule to remember here. There is an inverse relationship between interest rates and bond prices. Think of it as a seesaw. When market interest rates go up, bond prices fall. When interest rates fall, bond prices increase. This valuation logic depends on the aggregate discounted value of all the future cash flows you expect from the bond. Eventually, the bond reaches the end of its life. This is called redemption of a bond. When the maturity date arrives, the process is quite simple. The issuer repays the principal amount plus the final coupon payment to the investor. Once this payment is made, the bond is extinguished. It ceases to exist because the liability has been fully paid off. Now, let us discuss returns, starting with holding period returns or HPR. This calculates your total return if you bought a bond and sold it before maturity or held it for a specific period. The formula adds up three things: the coupons you received, the interest you earned by reinvesting those coupons, and the profit or loss from the difference between your sale price and purchase price. For example, if you buy at 104, earn an 8 rupee coupon, reinvest it to earn small interest, and sell at 110, your total return percentage is 14%. However, this is a crude measure and should not be compared to annualized returns. A simpler but less accurate metric is the current yield. This compares the coupon to the current market price, similar to the dividend yield of a stock. If an 8.24% coupon bond is trading at 104 rupees, you divide 8.24 by 104. This gives you a yield of 7.92%. The problem is that it ignores future cash flows like the redemption value, so it is not widely used for proper valuation. A much better measure is the yield to maturity or YTM. This is the internal rate of return for the bond. It balances the current market price, which is your outflow, against the present value of all future inflows, including coupons and the final redemption. It relies on two critical assumptions. First, that you hold the bond until maturity. Second, that all periodic coupons are reinvested at this same YTM rate. It gives a more complete picture of the return. But what if you don't hold it till maturity? Then we look at realized yield. This is used when your holding period is less than the maturity period. The critical difference here is the reinvestment rate. We assume the coupons are reinvested at a specific market rate, say 14%, which might differ from the YTM. The formula looks at the accumulated value of your coupons plus your sale proceeds divided by your purchase price. This gives you the actual realized return for the time you held the bond. Finally, we have a concept called duration. This measures the weighted average time it takes for you to receive your original investment back. It is calculated using the present value of various cash flows as weights. The rule of thumb is that duration is usually less than the actual term to maturity. This represents the Macaulay duration. When we modify this metric, we get modified duration, which is a measure of risk. It acts like a gauge for sensitivity. It tells us how much the bond price will change if interest rates change. Bonds with a higher time to maturity, a lower coupon rate, or a lower yield will have a higher duration. A higher duration means higher sensitivity. So, if interest rates move even a little, the price of a high duration bond will swing significantly compared to a low duration bond.